Unlocking cash ETFs. A balancing act for investors. Many investors face a familiar dilemma. They want to be ready for emerging investment opportunities, but they also want to avoid the risk of losing potential returns. Cash ETFs offer a solution, providing a balance between liquidity and yield. According to finance experts, the appeal of cash ETFs is clear. They cater to investors of all ages, offering a way to keep their cash liquid while still generating a modest return. Chris Merrick, founder of Merrick Financial, explains that these ETFs come in various forms. Some mimic high-interest savings accounts at major banks, while others invest in low-risk debt securities, known as money market ETFs. One of the key advantages of cash ETFs is their ability to preserve capital while maintaining liquidity. Unlike guaranteed investment certificates, which lock in funds for a specified period, cash ETFs provide flexibility. As Merrick notes, the liquidity is good. You get the interest income, which is better than a bank savings account. And often they're kept for short-term goals. The interest rates paid by cash ETFs are tied to the borrowing rates set by the Bank of Canada. However, as Merrick points out, when the rates go down, unfortunately like now, the interest rates are dropping for cash ETFs. Despite the lower yields, cash ETFs have been popular among investors. Erica Toth, director at BMO Global Asset Management, highlights that one of BMO's top-selling ETFs over the past year has been a money market ETF. Toth explains, they can offer advantages like the ability to de-risk a portfolio if an investor wants to move out of equities or bonds, since cash ETFs are a more conservative asset compared with more volatile stocks. Cash ETFs are particularly useful during times of transition. As investors age, their need for cash flow increases, making safer assets more attractive. However, young investors also find them valuable for saving towards specific financial goals. Toth emphasizes, even younger clients, saving up to buy homes or saving up for renovations or for children's education, it's still a good way to make sure you're getting paid something on your cash, and the funds are readily available. Additionally, cash ETFs can be a strategic choice for investors who have recently exited the market. Toth suggests, cash ETFs could help someone who recently got out of the market and wants the cash they have on the sidelines to be productive. Philip Patterson, chief investment strategist at IG Wealth Management, agrees that cash ETFs are a suitable option for investors seeking yield while maintaining liquidity. He advises, I think anytime an investor has a requirement where they need the cash within 12 months and they don't want to be subject to any market volatility at all, I think this would be a good place to be putting your money. However, Patterson also warns that cash can be a drag on long-term portfolio performance due to its lower returns. He recommends holding around 5% of a portfolio in a cash ETF to take advantage of market opportunities during volatile periods. Despite the benefits, cash ETFs do have a potential drawback. They are not covered by the Canada Deposit Insurance Corporation, CDIC, which guarantees up to $100,000 per account type at a financial institution. Merrick acknowledges, as the saying goes, liquidity and security don't matter until they are everything. But I feel that the chances of needing this are fairly low. In summary, cash ETFs offer investors a way to balance liquidity and yield, making them a valuable tool in an investor's toolkit. However, as with any investment strategy, it's essential to consider individual financial goals and risk tolerance.